Okay, so today we're going deep on something that I know a lot of our listeners are curious about. It pops up in the crypto world all the time, technical analysis, or TA.
Yeah.
We've got a pretty diverse set of sources to help us unpack this. Financial news articles, some academic research, even a Reddit thread where people are really letting their opinions fly, which, I always love.
Oh, yeah. It can get fiery, can it? Those Reddit threads.
Yeah.
Passionate a bunch.
Yeah, exactly. But that's what makes it real, right? We're not just talking theory here. We're seeing what actual traders think. And the goal today, well, it's to equip you with a solid understanding of what technical analysis really is, what it can do for you, but also those potential pitfalls to watch out for, especially in the wild world of crypto.
Yeah, because it's easy to get caught up in the hype, see some fancy chart patterns, and think, oh, this is it. I've cracked the code.
Exactly. But as we'll see, it's not always that straightforward.
Not at all.
Okay, so before we jump into the pros and cons and all that, let's just lay the groundwork here. What are we actually talking about when we say technical analysis?
Yeah, good place to start.
One of the sources we have, Trax, does a good job of outlining the core principles. The first one that really stands out is the idea that, okay, everything that's known about an asset, all the news, the developments, everything, is already reflected in the current price. So instead of digging into all that background info, a technical analyst just focuses on that price action.
It's all there, baked right into the chart, they say.
Yeah, exactly. And then building on that, you have the principle that prices move in trends. So once a price starts heading in a certain direction, the assumption is it's more likely to keep going that way than to just do a complete 180.
The trend is your friend until it's not, right?
Exactly. But of course, figuring out when that friend might turn on you, well, that's the tricky part.
Yeah, that's where the skill, the art of it really comes in.
And the third key principle, this is the one that always kind of fascinates me, is the idea that history tends to repeat itself. And I don't mean in some grand, destined to happen kind of way. It's more about human psychology. People tend to react in somewhat predictable ways to market events, fear, greed, FOMO, the drill. And those emotions can lead to recurring patterns in how prices move.
Yeah, it's almost like crowd psychology playing out on the charts, isn't it?
Exactly. So instead of trying to predict the future, it's more like recognizing these patterns, understanding how they've played out in the past, and then using that to, at least try to anticipate what might happen next.
It's probability, not prophecy, right?
Exactly. Okay, so that's the basic idea. You're looking at price, volume, charts, trying to glean insights from those patterns and indicators. And this is in stark contrast to, fundamental analysis, which we've talked about before.
Right. Fundamentals dig into the intrinsic value of an asset. Like for a company, you'd be looking at their earnings, their management team, their market share, all that stuff. But in crypto, it'd be more about the projects team, the technology, the use cases, the overall adoption rate, all that good stuff.
Exactly. So TA is all about price action. And fundamentals are about what's actually backing that price, Are we seeing real value here, or is it all just hype?
Right. Two very different but potentially complementary ways of approaching the market.
Okay, so now let's get into the good stuff. Is technical analysis actually effective?
The million-dollar question, or should I say the Bitcoin question?
Exactly. And, as with most things in trading, there's no simple yes or no answer. We've got some sources here that are firmly in the TA as bunk camp and others who see real value in it.
Yeah, that skepticism is pretty clear in that Reddit thread you mentioned. One user straight up called it nonsense, especially when it comes to trying to predict those short-term price moves.
Yeah, some people see it as almost like reading tea leaves or, that other comparison that always comes up, astrology.
Oh, yeah, that one's a classic. But, there's a whole theoretical framework that kind of supports this skepticism. Coin Bureau does a good job of explaining the efficient market hypothesis, or EMH, which basically says that asset prices already incorporate all available information. So any future price movements are essentially random, what's often called a random walk.
So if EMH is true, then trying to use past price patterns to predict what's going to happen next would be totally futile.
Yeah, you might as well just flip a coin.
Right. But, like any good debate, there's another side to this story. That research paper you sent me, it actually suggests that rational investors who are learning from market data can create a degree of predictability. Not perfect, of course, but enough to potentially give them an edge.
Interesting. And how did they test that?
Well, they focus specifically on the relationship between prices and their moving averages. Those lines you see on charts that kind of smooth out the price action and help you see trends more clearly.
Right.
And what they found was that strategies based on these moving average ratios, they actually outperformed a simple buy and hold strategy, not just for Bitcoin, which, is already volatile and kind of unpredictable, but also for certain stocks that are notoriously difficult to value using fundamentals alone, like small cap companies, young firms, even NASDAQ Q stocks during the dot-com bubble.
So they're saying that even if markets are mostly efficient, the very act of investors observing and reacting to these technical signals, like when the price crosses above or below a certain moving average, can actually create a kind of self-fulfilling prophecy.
Yeah, exactly. It's like enough people start believing something's going to happen based on these signals, and then their actions in the market actually make it happen.
Interesting. And I remember that in the Reddit thread, even though there was a lot of skepticism, some users did point out that TA can be useful for identifying scenarios where certain outcomes are more likely. It's about probabilities, not guarantees.
Right. Like one user said, it doesn't tell you what will happen, but it can show you what's more likely to happen.
Exactly. And they even drew a comparison to professional poker, which I thought was really insightful.
I remember that. They were saying that in poker, just like in trading, success isn't about being right all the time. It's about consistently finding those small edges, those situations where you have a slightly higher probability of winning, and then carefully managing your risk to stay in the game long enough for those edges to play out in your favor.
And they specifically mention risk management, right, which is absolutely crucial no matter what approach you're using.
Yeah, they even talked about a position sizing strategy based on something called the average true range, or ATR. Basically, using that to determine how much of your capital you risk on any given trade.
Right. Because even if your analysis is spot on, one or two big losses can wipe out a whole bunch of smaller wins.
Exactly. So it seems like the consensus, or at least a more balanced view, is that technical analysis isn't some magic bullet, but it can potentially give you a slight statistical edge in certain situations.
As long as it's used in conjunction with proper risk management and perhaps even some fundamental analysis to add context.
Right. Okay, so now let's get into the nitty-gritty. Why can technical analysis fail in practice? Even if you have a solid understanding of those core principles, what are some of the pitfalls?
Yeah, that's where things get really interesting, and that VRD Nation source you provided had some fantastic insights on this.
Yeah, that was a really insightful one. Let's start with the idea of location of patterns, which I thought was so clever.
Oh yeah, the analogy they used really stuck with me. Would you accept food from a stranger? Most people would say, well, it depends.
Right, it's all about context. On a train, probably not. But at the temple during a religious ceremony, maybe?
Right. The location completely changes the meaning. And they were saying that's the same with chart patterns and technical analysis. Just seeing a head and shoulders pattern or bullish engulfing, that's not enough. You have to consider where it's forming within the broader price trend.
Yeah. Is it happening after a huge upward move? Or just a little sideways wiggle? The location tells you a lot about how significant that pattern might actually be.
It's all about the bigger picture. And VRD Nation also talked about the issue of time frame mismatch, which is something a lot of newer traders might fall into.
Yeah, this one's important. You can have patterns that are generally pretty reliable on longer-term charts, like daily or weekly, but if you try to apply them to super short-term time frames, like 5-minute charts, it's just noise.
Exactly. A double top on a 5-minute chart might mean nothing, but on a daily chart, it could be a serious warning sign. You have to use the right tools for the job.
And then there's the whole issue of liquidity, which, is especially relevant in the crypto world.
Right. As VRD Nation points out, technical analysis is all about the psychology of the masses. It works best when you have a large number of traders, all with different motivations, buying and selling, creating those patterns.
Yeah, it's like a collective wisdom of the crowd kind of thing.
Exactly. But when you have an asset with low trading volume, a few big players can really distort the picture.
Or even coordinated manipulation efforts, like those pump and dump schemes that Coin Bureau talks about.
Yeah, a few whales get together, artificially pump up the price, and then dump their holdings on unsuspecting newcomers who see those technical signals and think, ooh, this is a breakout.
It's heartbreaking, really.
Yeah. So low liquidity means those patterns might not actually be reflecting genuine market sentiment.
And VRD Nation also had that really insightful point about personal bias.
Ah, yes. We all have our favorites, don't we?
Exactly. If you really love a company or a certain crypto project, you might start seeing patterns that aren't really there.
Or if you've had some lucky wins with a particular asset in the past, you might be more likely to jump in again, even if the technicals aren't actually that strong.
VRD Nation even specifically mentioned liking a company or having past profitable trades as being sources of bias. They said it's super important to be aware of that and try to be as objective as possible when analyzing the charts.
Yeah, it's like that thing where if you're thinking about buying a certain car, you suddenly start seeing that car everywhere. Our brains are wired to confirm our existing beliefs.
Totally.
Yeah.
And then, of course, we can't forget about the impact of news and events.
Oh, yeah, those can really throw a wrench in the works.
Technical analysis is all about historical data, right?
Right.
But as some huge piece of news drops, a regulatory change, a major technological breakthrough, a big security breach, like some of those black swan events Trax talks about, it can completely change the game.
Past performance is no guarantee of future results, as they say.
Especially in the fast-moving world of crypto, where things change so rapidly.
VRD Nation actually said that when you see a stock or a coin behaving in a way that's totally unexpected, there's a high probability that some underlying fundamental news is driving that.
Makes sense. And Trading Bells also talked about how news and events are often the biggest drivers of volatility in the market.
Which can make those technical signals even harder to read.
And then to add another layer of complexity, Coin Bureau points out that directly applying technical analysis techniques developed for traditional markets to crypto must not always be the best approach.
Yeah, crypto is a different beast, isn't it?
Totally. It trades 24/7. It's way more volatile than most traditional assets, and liquidity can be all over the place. So you have to be mindful of those differences.
And then, of course, there's the ever-present issue of market manipulation, which, as Coin Bureau points out, is especially prevalent in smaller cryptocurrencies.
Those pump and dumps, the whales making waves, it can all create really misleading price movements.
Technical analysis can't really account for that kind of intentional manipulation.
So yeah, it's a lot to consider. I think the takeaway here is that technical analysis can be a powerful tool, but it's not some magic formula. You really have to understand its limitations, use it in conjunction with other forms of analysis, and always, always manage your risk.
Couldn't agree more.
Okay, so now let's shift gears a bit and talk about some of the specific tools and concepts that technical analysts use. The actual stuff you see on those charts.
Right, let's open up the toolbox.
So one of the most fundamental concepts is moving averages.
I've definitely heard of those.
Yeah, they're everywhere. Trax, Coin Bureau, Theseus, they all talk about them. You have simple moving averages, or SMAs, which are basically just the average closing price of an asset over a certain period.
Like a 50-day moving average or the 200-day moving average.
Exactly. And these SMAs, they help smooth out the price fluctuations so you can see those longer-term trends more clearly. Then you have exponential moving averages, or EMAs, which give more weight to recent prices.
So they're a bit more responsive to short-term changes in momentum.
Right. And Theseus actually looked at the effectiveness of using different SMA settings, which is interesting.
I bet. And what about those trading signals that people talk about? The golden cross and the death cross?
Yeah, those are classic. The golden cross happens when a shorter-term moving average crosses above a longer-term one.
Yeah.
It's generally seen as a bullish signal.
Like the 50-day crossing above the 200-day.
Exactly. And then the death cross is the opposite. The shorter-term MA crosses below the longer-term one. Bearish signal.
Got it. And what about Bollinger Bands? I've seen those on charts. They look kind of like an envelope around the price.
Yeah, they're cool. Trax and Theseus both explain those. You've got a middle band, which is usually an SMA, and then upper and lower bands that are set a certain distance away from that SMA, usually based on standard deviations.
Standard deviations. Okay, getting a little technical here.
Yeah, but the basic idea is that when the price touches or goes above that upper band, it might be overbought, due for a pullback. And when it touches or goes below the lower band, it might be oversold, a potential buying opportunity.
So it's kind of like a way of gauging whether the price is stretched too far in one direction or the other.
Exactly. And Trax points out that this can be especially useful in crypto, where the price can swing wildly from its average in the short term.
Makes sense. And what about the stochastic oscillator? I've seen that one too.
Yeah, that's another momentum indicator. Trax and Coin Bureau both talk about it. Basically, it compares the asset's most recent closing price to its price range over a certain period.
And what's that supposed to tell you?
Well, it's mainly used to identify those overbought and oversold conditions. If the oscillator is reading above a certain level, usually 80, it might be overbought. Below a certain level, usually 20, oversold. Forbes actually said that for identifying overbought or oversold levels, they often favor the stochastic oscillator.
Got it. So Kind of similar to Bollinger Bands in that way.
Yeah, kinda. They're both trying to gauge whether the prices move too far too fast.
Okay, makes sense. And what about support and resistance levels? Those seem pretty fundamental.
Absolutely. Tracks and that how to draw support and resistance resource both highlight those.
And what exactly are they?
So basically, they're price levels on a chart where you'd expect to see either buying interest or selling pressure. Support is like a floor, a price level where buyers might step in and prevent the price from falling further.
Got it. And resistance is like a ceiling.
Exactly, where sellers might come in and prevent the price from going higher.
So if the price breaks through a resistance level, does that mean it's going to keep going up?
Well, it could. It often means that the buyers are in control and the sellers have kind of given up. But it's not a guarantee.
Right. Nothing's ever guaranteed in trading.
Exactly. And what's interesting is that these levels aren't fixed. A resistance level that gets broken can actually become new support, and vice versa.
So it's all dynamic, constantly shifting.
Yeah, the market's always moving, isn't it?
Always. Now, what about those Fibonacci retracement levels? Coin Bureau mentions those, and they sound kind of mysterious.
Yeah, they do have a kind of mystique about them.
So what's the deal with those?
Well, they're based on the Fibonacci sequence, which is this series of numbers where each number is the sum of the two preceding ones.
Yeah.
1, 1, 2, 3, 5, 8, and so on.
Right, I remember that from math class. But what does that have to do with trading?
Well, certain ratios derive from this sequence, like 23.6%, 38.2%, 61.8%. These are plotted as horizontal lines on a price chart.
Between a significant high point and a significant low point, right?
Exactly. And the theory is that these lines can act as potential support and resistance levels during price pullbacks or rallies.
So it's like these Fibonacci ratios are somehow encoded in the market's movements?
Yeah, that's the idea. And that cryptocurrency technical analysis,
Right.
a beginner's guide, even shows an example of this, applying the Fibonacci tool to a Bitcoin chart.
And did it work?
Well, I mean, you can see how the price interacts with those Fibonacci levels, sometimes bouncing off of them, sometimes breaking through. It's definitely something to consider.
Interesting. Okay, moving on. We've got the HAM-CD, or moving average convergence, divergence. I know Forbes mentioned that one, giving a sell signal for Bitcoin at some point.
Yeah, it's another popular indicator. He talks about that one too. Basically, it shows the relationship between two moving averages, and it can signal potential shifts in the direction and strength of a trend.
So when those two moving averages cross over, that can be a signal to buy or sell.
Potentially, yeah. But Theseus found that the MAPCD was only consistently profitable on a couple of very specific settings out of the many they tested.
So it's not a foolproof indicator by any means.
Definitely not. And then there's the RSI, or Relative Strength Index, which Coin Bureau and Theseus both discuss.
And what does that one measure?
It's a momentum oscillator that looks at the speed and change of price movements.
Okay.
It's on a scale of 0 to 100, and readings above 70 are generally considered overbought, while readings below 30 are considered oversold.
So it's kind of another way of looking at whether the price has moved too far too fast, like Bollinger Bands and the stochastic oscillator.
Yeah, in a way, although they all use slightly different calculations.
And did Theseus find the RSI to be more reliable than the LCD?
Interestingly, they did. They actually said it was the best performing technical analysis method out of the ones they tested, although it still wasn't consistently profitable in their study.
So again, no silver bullet.
Right. And finally, we have to talk about candlestick charts, which Coin Bureau really emphasizes as a crucial tool for traders.
I've definitely seen those. They look like, well, candlesticks.
Yeah, that's where they get their name. Each candlestick represents the price action within a certain time frame, like a day or an hour.
And the shape and color of the candlestick tell you something about what happened during that period, right?
Exactly. It shows you the opening price, the closing price, the high, and the low. So just by looking at a series of candlesticks, you can get a pretty good sense of the battle between buyers and sellers, the prevailing sentiment in the market.
Coin Bureau points out that while the basic principles of candlestick analysis are similar to those in traditional markets, the unique volatility and 247 trading in crypto can make interpreting them a bit more nuanced.
Yeah, you have to be aware of those differences.
Okay, so that's a pretty comprehensive overview of some of the key technical analysis tools. But, as we've been saying, no single tool is perfect.
Absolutely not. VRD Nation actually says that even the most sophisticated technical analysis might only have a success rate of 60–70%.
Wow, That's a lot lower than I would have guessed.
Yeah, and they really stress the importance of accepting loss as a part of the game.
Makes sense. If you're only right 60% of the time, you're going to be wrong a lot.
And they also say that technical analysis should be approached from a psychological perspective. It's about understanding the behavior of traders, those emotional responses that drive market movements.
Because ultimately, it's those human emotions that are reflected in those chart patterns, right?
Yeah, it's like a giant collective psychological experiment.
Fascinating. And you also mentioned that context is crucial, right?
Absolutely. VRD Nation uses the example of a bullish pattern in a stock that might fail to play out if the entire industry sector is in a downturn. You can't just analyze an asset in isolation. You have to consider the bigger picture.
And that poker analogy from the Reddit thread really emphasizes that point too, right?
Totally. It's about finding those small edges, managing your risk, and staying in the game long enough for those edges to work in your favor.
They even mentioned a specific position sizing strategy using the average true range to help manage that risk.
Yeah, super important. And FX Open brings up another crucial point, which is the danger of overfitting your trading models to historical data.
What does that mean?
It means that if you try to make your technical analysis strategy fit the past data perfectly, it might not work well at all when faced with new unseen market conditions.
Ah, so it's like studying for a test by memorizing the answers to last year's exam.
Exactly. It might get you a good grade on that specific test, but it doesn't mean you actually understand the material.
Right. You need a more adaptable approach.
And that's where combining technical analysis with fundamental analysis can be really powerful, as Coin Bureau and Trax both suggest.
So the technicals can tell you the when and the how of a potential trade, and the fundamentals can help you understand the why.
Exactly. It's like having two different lenses to view the market through.
Makes sense. And lastly, we have to reiterate the importance of managing emotions, which both VRD Nation and Trax emphasized.
Yeah, fear and greed can really mess with your decision making.
It's so easy to get caught up in the FOMO or panic sell when the market takes a dip.
Exactly. That's why having a predefined trading plan with clear stop loss and take profit orders is absolutely crucial.
It helps you stay disciplined and avoid those impulsive decisions that can really hurt you in the long run.
Totally. So before we wrap up this deep dive, there's one more interesting angle I wanted to touch on. You sent me that article about the potential role of AI in investment research, artificial intelligence for investment research.
Right. It's fascinating how AI is starting to impact pretty much every field, including finance.
Yeah, and the article suggests that AI could be particularly useful in technical analysis because of its ability to process huge amounts of data and spot complex patterns that humans might miss.
So it's like having a superpowered analyst at your disposal.
Exactly. It can sift through all that historical price and volume data, identify those subtle trends, and even adapt to changing market conditions over time.
That's amazing. And I guess it makes sense. I mean, technical analysis is all about recognizing patterns, and that's something AI is really good at.
Right, so while AI might not be replacing human analysts anytime soon, it's definitely becoming a powerful tool that can augment their abilities.
Okay, so as we wrap up this deep dive into the world of technical analysis, what are some of the key takeaways you'd like our listeners to remember?
Well, I think the most important thing is that technical analysis can be a valuable tool for understanding market sentiment and potentially identifying trading opportunities, especially in the crypto world. But it's not some foolproof system that guarantees profits. It has its limitations, and its effectiveness is still debated.
Right. The research paper we discussed suggested it can help identify probabilities, but many people, especially when talking about short-term trading, remain skeptical of its predictive power when used in isolation.
Exactly. So you always have to be aware of those limitations, manage your risk, and ideally combine technical analysis with other forms of analysis, like fundamentals and an understanding of market psychology.
And perhaps one of the most profound insights, as VRD Nation emphasized, is to really try to understand the human element that drives market movements. Those chart patterns are ultimately a reflection of the collective behavior and emotional responses of traders.
So the more you can understand that human element, the better equipped you'll be to navigate the markets, whether you're using technical analysis, fundamental analysis, or a combination of both.
Well said. Now, I'm curious, what were some of your biggest aha moments during this deep dive? And what areas of technical analysis are you now even more intrigued to explore further?
That's a great question. I think for me, it was really solidifying the idea that technical analysis isn't about predicting the future with certainty. It's about understanding probabilities, managing risk, and using those patterns and signals to gain an edge. And I'm definitely more interested in exploring how AI can be used to enhance technical analysis. How can we leverage those powerful algorithms to sift through the data and find those insights that humans might miss? It's a fascinating field, and I'm excited to learn more.
Me too. This has been a really insightful conversation. Thanks for diving deep with me.
Absolutely. And thanks to all our listeners for joining us on this journey. We'll see you next time for another deep dive.